All right, let's go to the balance sheet. The next page, you'll see the example of the balance sheet. By definition, a balance sheet is a statement of assets. Assets are things that a company owns. Liabilities are monies that a company owes. These are debts that we have. And net worth is the owner's financial interest in the business, all at a particular point in time. Assets, liabilities, net worth at a particular point in time. So right away, we see the difference between the income statement and the balance sheet. The income statement, remember we said, was like a video of financial performance over a period of time. A balance sheet is like a snapshot of your company at a particular point in time, like this minute. What do we own? What do we owe? And what's the owner's interest in the business? Three things that show up on the balance sheet. I said 75% or so of small businesses look at an income statement. My little bit of research indicates that about 50% of small businesses look at a balance sheet. Not quite as popular, which is unfortunate because in some cases, in terms of information, the balance sheet is more important than the income statement, particularly to small businesses. I want you looking at both income statement and balance sheet. All right, so we've got an example of the balance sheet there in your handout. So it says sample balance sheet as of January 31st, 2000XX. So again, on this day, this is what we have. The balance sheet has three sections, as I referenced earlier. The first section are the assets, what the company owns. Those assets are broken down into short-term assets, which we call current assets, and long-term assets. Sometimes we refer to those as fixed assets. By definition, a current asset is an asset that we can liquidate. Liquidate means turn into cash. An asset that we can liquidate within 1 year or less. Current asset. Long-term asset is an asset that on average takes more than 1 year to liquidate. So on our example here, current assets, we've got cash. This is the money in our corporate checking account. Accounts receivable, monies that are owed to us by our clients. If we have inventory, it would show up as a current asset. And then any other miscellaneous current assets. So we have total current assets, 203,112. Next, we have our long-term assets, any land that we own, building, equipment, any intangible assets. And then once we've identified those assets, we also show what we call accumulated depreciation or amortization. This means how much over time have we expensed our fixed assets? And in this case, over time, could be 3 years, 5 years, 10 years, we have accumulated depreciation of $76,000. Those numbers come right from the income statement. Every year, at the end of the year, we take the depreciation expense on the income statement and we shift it over to the balance sheet, and it shows up as accumulated depreciation. So that gives us a net value of our long-term assets of $286,500. We add in some deposits, some other miscellaneous assets. We get total assets of $507,112, $507,112. Total assets.